How's the sound right now? Hello and welcome. Huber, welcome. Happy Thursday. This is a new time for us. It's also a new year for us. It's also a new year for everyone watching. So how are you doing today, Huber?
Doing great. Excited to be here. Excited for the new year ahead, guys.
All right. So we're doing a December 2023 review. It's the first week of January 2024. In addition to doing a review of December and happenings in the commercial real estate finance capital markets, we're also going to be looking at what were the key events that happened in 2023, give a little bit of a preview of our expectations for the months ahead. And so first, we're going to dive into what happened in December. Besides having some holidays and some cookies and parties in the capital markets. So a couple of things regarding rates, which is something that is crucial for the commercial real estate capital markets. Rates, cost of capital. So we have news on both the long-term rates and short-term rates. So Federal Reserve, Federal Open Market Committee, they did nothing at their meeting except maybe they changed everything. They talked about lowering rates in 2024, and they talked about potentially lowering rates 3 times this year. Now, there's no commitment from the Fed. Obviously, they're going to have analysis and open market committee meetings several times this year, as they do each year. The market was already betting that the bond market and people that are trading on the futures of bond yields were already betting that the Federal Reserve was going to be bringing down some short-term rates this year as they get away from rate hikes and then a pause. And so there is now an expectation from the market that we're going to have potentially 3 rate cuts for the Federal Reserve and overnight lending rates this year. On the long-term side, we saw Treasury yields really fall back down to earth. So Treasuries and the 10-year Treasury in particular, the yield spiked in late October. So since October 19th, we've seen more than 1 full percentage point, so 107 basis points drop in the 10-year Treasury rate, including 49 basis points in December. That is a steep drop in Treasuries. We'll be talking a little bit about the impact of that on the commercial real estate capital markets in a bit. Finally, for December, office is still a dirty word. So we talked about that earlier in Q4, where lenders being extra cautious on office properties, values of office properties at best being in question, at worst crashing. Lenders are still extra cautious on anything that is an office that is not either medical office with strong tenants or an office with an exceedingly strong tenant with a long-term lease. And so we're talking credit grade tenants with a long-term lease. Those are bucking the trend. Office is a dirty word otherwise. So that is some of the December news. As we look towards our data, we are looking here at inflation and the 10-year Treasury curve and what they did over the 12 months of 2023, along with some key events. So Huber, let's go back and forth a little bit. And we went through all of our presentations from last year, and we talked about what were the key markers. So we have lines here for the 4 times the Federal Reserve Open Market Committee raised their target rate last year, which you can see in red. The first event from last January that kicked things off in what was a difficult year for commercial real estate investors, a difficult year for financiers. And that first item is apartment demand turning negative. So that was last January 5th, almost a year ago to this day. Tomorrow, it'll be a year to the day when RealPage came out with a big report, industry report, and RealPage has a lot of property management data and accounting data under their belt. They reported that apartment demand turned negative for the first time since 2009. So that is demand for new apartment leases. So that was what kicked us off news-wise last year. What happened next, Huber?
Yeah, the second one in March was our biggest one. I think we all remember it, Silicon Valley Bank failing, one of the largest bank failures in U.S. history. I mean, it's kind of weird because I guess it was also so long ago when that happened. But yes, it was March 2023. One of the great signs is that we didn't see a total collapse. When that happened, it was a big event in the industry where there was a lot of fear that, hey, if Silicon Valley Bank could go down, will more banks after that collapse? Will there be a total collapse of the banking system? So fortunately, not a total collapse. We did see some notable ones, Silicon Valley Bank, First Republic Bank, Signature, but we didn't see a total collapse of the system. So that was very welcome to end the year.
Following in Q2, so April and May, we saw news and reports of major sponsor loan defaults and handing back properties in major markets. So we're including Blackstone, the largest owner of commercial real estate nationwide, Brookfield, other institutional sponsors, giving up particularly on some office buildings that were not performing well, not seeking workouts, not pumping fresh equity into these buildings, but giving them back to lenders and saying, hey, we're underwater on this loan, have at it. Have this huge, million square foot office building that we can't lease in New York. And on select multifamily properties as well. So there was negative headlines through much of the year for multifamily in addition to office. So April, May, we saw reporting around major institutional sponsors giving back these properties.
Right. Then in May, one of the big industry reports, Mortgage Bankers Association, they came out with commercial mortgage originations showing that in Q1 of 2023, they were down about 56% year over year. So with all of the rates that increased in 2022, those rate increases that we saw the year prior, this was somewhat expected with rising rates. There was much more discussion around this time about bid-ask spread. And of course, just as a reminder for people, the bid price from buyers not meeting the asking price from sellers. So in May, that MBA report kind of confirmed a lot of the sentiment that we were hearing of not many transactions, not many originations taking place in the beginning of the year.
Yeah, and that was probably the beginning of what we've referred to over the last 6 months of the transaction winter, where properties really reduced the amount of properties that are trading hands and a bid-ask spread on many asset types nationwide that led to a reduced investment and financing activity. Next up, also in May, was when Congress reached a bipartisan compromise to avoid a Treasury default. So through this period, as these news articles are coming out, the Federal Reserve is not only raising rates, but Treasury yields were increasing. That was increasing the stress on the government to service its debt, stay within budget and within the previous debt ceiling. Congress did reach that compromise in May, and they gave a 2-year lifespan on a new debt ceiling. Some would argue a more flexible debt ceiling for the government to spend, to increase the national debt so they can meet their obligations. And that was in May as well, and fueled what happened next, Huber.
Yeah, forwarding to August, that kind of fueled the Fitch downgrading U.S. Treasuries, U.S. Treasuries. So that was not a welcome sign. Obviously, very bad news moving from the safest AAA rating to AA+. What does that mean? U.S. debt became riskier. So with this increased risk perception in combination with Fed rate hikes, that continued, and you see it on the graph here, it continued to push rates even higher, us being riskier as a country. And our safe haven, the U.S. Treasuries, not being the safest class anymore, that just continued to further and increase risk.
Right. And so that further fueled the rise in Treasury rates that was happening all year, and with commercial property values needing to catch up and do price discovery, kept transaction volume down. And eyes stayed on the US and domestic and monetary and fiscal really for the next few months until in October, eyes were back internationally with the Israel-Hamas war that broke out in October, the second developed country war in as many years after Ukraine and Russia, fueling further economic uncertainty. Now, we did not see an official recession anywhere in the news or in the economic data for this year. We saw a steep rise in treasury rates. We saw inflation come down, not quite hit the target, but inflation to come down. We also saw treasury yields come back down starting in October with the expectation that there would be some more stimulus of some sort coming from the Federal Reserve government, both. So that leads us into where rates are today. Huber, can you walk us through how we're doing on commercial mortgage rates today versus where we were a year ago?
Absolutely. So for those that have been tuning in with us, you'll recognize this graph here where we're tracking the current rates on the different types of capital providers, from agencies to debt funds, life insurance companies. What's different about this graph that you see today is that it's showing a side-by-side between where we were last year, so let's say January 2023, to where we are today, January 2024. And one of the big takeaways here is that you see agencies, so that's Fannie Mae, Freddie lenders, apartment lenders. In some cases, they actually have better pricing than they were a year ago to this day. Now, I know recency bias, a lot of us are just looking over the past couple of months where things have been moving, but looking at a longer spectrum here, they actually are lower. So that is a welcome sign. And with recent Fed rate cuts, overall, we are down. Now you'll see that other lenders on here, maybe they're still higher, like debt funds, others may be higher than where we were, but it is a welcome sign that agencies are lower. And then we're hoping and expecting that trend to continue, that overall other types of lenders will continue to fall as rate cuts continue into 2024. So lastly, with this new year, pricing discovery, as market confidence builds, then there's that potential for spreads to continue to tighten, to come down. So we're looking forward to 2024 and that overall trend of lowering rates, easing and helping the market.
Right. So rates are getting close to where they were a year ago. How is that impacting, and what else are we seeing with underwriting and deal structure for commercial mortgage deals today?
Sure. So absolutely. In December, and what we're kind of seeing here is valuation starting to correct as trades occurring. Deals now are being underwritten to lower values. Q4, the last quarter of last year, we started to see these decreases in property values as sellers started to come to the table with the realization starting to sell at higher cap rates. What that changed is both DSCR, again, from an underwriting side, both DSCR and LTV coming back into play when it came to loan sizing for lenders. So if you guys remember, I'm sure we all dealt with it in 2023, there was a supreme focus on DSCR. Values hadn't yet been realized yet, that lowering value hadn't been realized. So lenders, and with increasing rates, that caused a lot of loan sizing to be lower than what borrowers were expecting because interest rates were higher. It got tougher to get the loan proceeds that you needed. So while last year, the big focus was on, does the DSCR constraint allow you to size for the loan that you need? Now what we're starting to see is both DSCR and loan to value ratio. As those values come down, if lenders are sticking to that 65 to 75% LTV stipulation, LTV constraint is going to be one of those factors that is coming back into play. And to further that, lenders are being more cautious on reliable comparables. We talked about transaction winter. Transactions were lower in 2023 and certainly lower in the holiday seasons, the last quarter of last year. Now, we expect that to start picking up. But in the meantime, lenders will be cautious on if there are existing comparables that they can use, how much can they trust those comparables, or are the ones being used outdated, and trying to find those reliable comps to justify where the value is today.
Excellent. Thanks, Huber, for walking us through how lenders and capital sources are viewing deals. We talked a little bit about what we're expecting in the months ahead. Can you walk us through some of the really main points of like what investors and lenders alike should be expecting in the next few months?
Absolutely. I mean, we're excited for 2024, right? With lowering interest rate environment, it's going to bring much more activity to the table. So one of the things is banks willing to, what we're seeing right now, and we're expecting in the months ahead, is banks willing to negotiate loan extensions. So if you have a loan that's coming due, and you're still hope you are looking for more proceeds, and you're expecting that in a lower interest rate environment, you're going to get those proceeds, right? Banks may be willing to negotiate loan extensions. Of course, there's usually a trade-off there. We'll talk about that later, but they're more willing to come to the table with those conversations. Second here is equity starting to take warm-up swings, largely on the sidelines as we were in that discovery mode for 2023. Where are rates going to end up? Are they going to continue to rise? Equity was largely on the sidelines, so we're expecting them to come back to the table, and you're going to start seeing more equity deals. One of the things we talked about in previous sessions is previous equity providers that we had moving to safer parts of the capital stack, being in that preferred equity tranche or mezzanine debt tranche. We're expecting them to come back into that JV LP space. Third that you see here, debt funds storing dry powder. So now that dry powder is starting to be put to work as market confidence builds. We're expecting that dry powder to come off the sidelines, and similar where equity is coming off the sidelines, that dry powder now being available and confidence being restored. And then lastly, you see there in the fourth bullet point, owners starting to analyze that sell versus recapitalization scenarios. Do they still sell the property? Are they now able to recap the property, refinance the property? Running that analysis on which one is best for their investment decisions. We're going to start seeing that theme play out, that business plan play out this year much more.
Excellent. Well, I'm going to give our standard 15-second commercial for StackSource, and then we're going to go to question and answer. So if you have questions about some of this material or what's happening in the capital markets and you'd like Huber and I to weigh in, please hit us up in the comments if you are watching live. If you're watching this later, sorry, too late for the comments, email us at hello@stacksource.com. But StackSource, so we are a team of expert capital advisors nationwide that put together debt and equity for the ideal capital stack for real estate deals. We have nationwide reach. We've closed in 46 states, $1.5 billion in transaction volume. We find competitive terms from more than 1,000 capital providers, and we operate with transparency. We have a transparent fee model that we get paid when the deal goes through successfully. And we have a transparent process because you get to see online who you're matched to and what quotes you're getting back. So that is StackSource. We're at stacksource.com. Let's go ahead and transition to Q&A. Once again, drop some comments in. We did receive some questions ahead of time, and we'll start with those. And please comment in with your own questions if you're watching live on YouTube or LinkedIn. First one up, Huber, I'd like to get your take. How did the projected rate cuts by the Fed in 2024 impact the commercial real estate financing landscape?
Sure, absolutely. I think it's a welcome sign that these rate cuts are happening. It's going to give investors, developers much more ease. So I think it's going to lead to more market. First comes the optimism, right? You hear my voice, we're excited for it. First comes the optimism, then I think it'll lead to more increased confidence in the market, which will undoubtedly lead to more transactions being done. I think with debt should be cheaper, right? We're seeing that trend already. U.S. Treasury starting to come down, giving ease to our clients, to borrowers. So debt should be cheaper now compared to where they were in the second half of last year. And a theme that dominated last year, like we talked about DSCR ratios, but that term cash in refinances. So we're expecting less need. There are going to be cases where cash in is required and necessary, but maybe less of a need for cash in refinances. However, as we talked about, LTV can still be a prohibiting factor in some cases. So those are some of the projections that we have as rate cuts continue and what we're expecting for 2024.
Excellent.
So looking at what we have, questions coming in. Tim, this one's for you. How have recent fluctuations in the 10-year Treasury yields affected commercial real estate financing terms and rates?
Aha. Okay. So the 10-year Treasury yield is one of the most commonly used indices when commercial mortgage lenders that we consider permanent lenders are determining their range of rates. So life insurance companies, agencies like Fannie Mae and Freddie Mac, banks and credit unions all consider the 10-year Treasury, or they explicitly set their rates as a spread on top of treasury yields like the 5.7 and especially the 10-year treasury yields. So the treasury yields coming down would usually mean parity with banks and credit unions offering lower rates on commercial mortgages. That's a great thing for a range of commercial real estate developers and investors. However, right now, banks and credit unions are remaining cautious in other ways besides their rates. So rates are coming down with banks and credit unions, but they have one foot on the brake when it comes to leverage and terms and working with borrowers that they don't already have a good relationship with. So there's still this caution in banks and credit unions because of potential softness in their balance sheet, waiting for their balance sheet to shore up, looking for more deposits, or just a degree of uncertainty with the economy. So it is going to mean lower rates, and that's good. The agencies are really going to be pushing on the gas when it comes to multifamily refinances, especially for stabilized properties. But I think a lot of that slack is going to have to be picked up with debt funds that have the dry powder to do it. And for banks and credit unions, they're really going to be looking for the strongest deals with the strongest sponsors financially. And so it's not going to be the same party that we usually see when treasury yields are sinking when it comes to bank and credit union. And it's going to be more of a search, finding the right bank and credit union for your deal if you're somewhere on the margins. Huber, what are some key considerations for property owners when it comes time to, you talked about the months ahead, selling versus refinancing or recapitalization. What are some of the key considerations when analyzing that?
Okay. When it comes to selling versus recapitalizing in those scenarios, well, I think what we talked about is lowering rates. So if I was an investor, or if we're talking to clients here, it's like, are you able to recap now, given these lower rates? Like maybe you weren't a couple months ago, and the thought was, man, is there going to be ease? So you've gone down the track of, okay, we're going to sell. But it could be worth your while to rerun that analysis and say, okay, with lowering rates and where they are now, maybe I talk to StackSource and I ask, hey, where our rates are on my deal, right? Maybe there is that opportunity now. There's something that can be done in the capital stack, in the capital markets today, which weren't available to you a couple months ago. So that's probably one when it comes to, hey, am I selling? Should I think about recapping or selling? What are my possibilities today? And then lastly, when it comes to selling, you always have to ask yourself, well, are the buyers there yet? Like, we've just got through the holidays. Are the buyers there at the price that you want? Or one of the things we talked about, negotiating an extension, or would it be worth your while to wait as more buyers build confidence and come to the table and we find that price discovery happening this year? So those were to be some of the key considerations is, can you recap in this current market? Or if you are going to sell, are the buyers there currently, or do you have that ability to wait as the market continues to build confidence this year?
Right.
Let's see, question pool here. One just came in. Tim, what are some of the negotiation strategies? What negotiation strategies are banks open to when it comes to loan extensions, and how might that affect borrowers?
Okay. So it's going to depend a little bit on the type of lender that you have a commercial mortgage from when it comes to working out a business plan that maybe has not come to fruition and now you're exploring this workout versus what you just explored, Huber, which is, I can sell this property, I can recapitalize this property. If neither of those are attractive in the short term, or you think buying time with your current lender is going to be accretive to the business plan, I have more time to accomplish the business plan. If you're working with a bank or a credit union and you're a financially strong borrower otherwise, and you need time with that asset, there are going to be some terms that are negotiable. One of those can be the maturity date itself and receiving an extension, potentially a blend and extend. So looking at today's cost of capital, how does it compare with your original financing term sheet? There may be able to be negotiated in an interest-only period until a future point when it starts to amortize again or when it matures. The maturity date, interest-only, potentially having good news reserves. Many of the points that are negotiable at the beginning of a commercial mortgage term sheet may be able to be renegotiated at the time where an extension may be needed, because a bank's alternative is going to be taking on an asset and asset managing and trying to sell either the note or sell the property. If you're a strong sponsor with a strong track record, they may be willing to negotiate some of these points. There are a lot of workout specialists out there right now that are starting to get busy. They're starting to get busy talking to borrowers that have marginal, hey, this is not a bankruptcy scenario, but I'm not getting the sales price or the recapitalization options that I want. And this is where workout specialists are coming in and saying, based on the type of lender, this is exactly what's negotiable. If you're with a private lender that may want to take over that asset, you may have much less room to negotiate because they may be chomping at the bit to take over that asset if they were a loan to own shop all along. So it's really going to depend on who your lender is to determine what, if anything, may be negotiable as you're coming up on the end of a loan period. Last one here, and we can wrap it up. Hubert, how do you anticipate the potential rate cuts affecting borrower behavior in the coming months?
Sure. With rate cuts, I mean, kind of similar to my first answer here, increased confidence, more optimism, confidence. You have more flexibility what you can do with your loan. So I think it'll lead to more activity, more transaction volume being done in the first 2 quarters of this year. And then again, what I mentioned before, less need for a cash in refinance because those lowering rates will give borrowers relief. And I think that is going to be a welcome sign in 2024 as that trend continues and the guidance that we get from the Federal Reserve on where the trend of rates continue to go.
Excellent. With that, if you're a borrower, lender, real estate investor that's interested in working with StackSource, please do reach out to us at hello@stacksource.com. Huber or I or one of our colleagues will be in touch with you about how we work and how we can work together. Thank you, everyone, for joining our first capital markets update of the year. It's been a pleasure walking through, and we hope to see you soon.
Thanks, everyone.